Welcome students, welcome to lecture number 17 of the module Income under head Profits and Gains from Business and Profession under the subject Direct Taxation. So as we already know that this particular module covers all these aspects as per video syllabus, that is computation of income from PGBP. PGBP stands for Profits and Gains from Business and Profession. Basic methods of accounting, scheme of business deductions and allowances. So all these three we have already seen in lecture number 16. Okay, now today we will be continuing with the scheme of business deductions and allowances. So before I begin the module 3, every time I just want to revise this particular format for computation of income from the head, profits and gains from business or profession. So we know that it begins with the net profit as per the P&L account, because profit is nothing but all your incomes minus expenditures, which is visible in your profit and loss account. That is why we are taking net profit as per the statement of P&L account. To that, we are going to add all the expenses which is being debited to P&L account, but as per the Income Tax Act, such expenses are not allowed to be deducted. So we are going to add that. We are going to less all the expenditures which are actually allowed as per the Income Tax Act, but either they are skipped or they are omitted to be debited to the P&L account. Then we are going to less the incomes which actually shouldn't have come under the head from the taxability under the head profits and gains from business or profession, or they are not taxable under this head. Therefore, we are going to deduct such expenditures, and we are going to add deemed income. Deemed income means which is not actually your regular income, but such income like recovery of bad debts or maybe any cessation of trading liability. So that is deemed income which you're going to add back, and then whatever you receive is nothing but profits and gains from business or profession on which you are going to charge the tax, or you're going to calculate tax on income from the head profits and gains from business and profession. So let us continue with the scheme of business deductions and allowances. This is very, very important, because once you remember what is to be added to the net profit, what is to be deducted to the net profit, easily you can solve any sum on profits and gains from business or profession. So we know that the computation is covered under section 29, and from section 30 to 43D we have certain deductions and allowances. So there are certain admissible deductions under section 30 to 37, which we have already covered in yesterday, which we have already covered in our previous lecture, that is lecture number 16. So today we will be seeing inadmissible deductions, expenses or payments which are deductible only in certain circumstances, profits chargeable to tax, and other provisions. So moving ahead to inadmissible deductions. Now, what do you mean by inadmissible deductions? It means that these are expenses, but they are not allowed to be deducted from your income in order to calculate the net profit. So you're not allowed to take the benefit of this expense. You're not allowed to deduct these expenses from your income. So what are the inadmissible deductions under section 40? Let us understand. In the case of any SSC, the following expenses are not deductible. When I say not deductible, means they are not allowable expenses. Though they may be an expense, but Income Tax Act disallows it. So the first one is any interest, royalty, fees for technical services or any other sum chargeable under this act, which is payable outside India, okay, or it is payable in India to a non-resident, non-corporate resident, or to a foreign company. So what do you understand by this? We understand by this that whatever interest, royalty, or whatever fees is being paid, but such interest, royalty, fees is only paid for technical services or maybe any other for any other thing which is actually chargeable under the act. But if it is payable to any person who is outside India, or to a person who is in India but who is a non-corporate, non-resident, or to a foreign company, okay, on which tax is not deducted at source. So you know there is a concept of TDS. TDS is where tax is not deducted at source, which means that when certain person is receiving the money, okay, if he has to receive the money and the person who has to pay the money deducts certain tax amount on the income before paying it, it is called TDS. So if such TDS is not paid, then this expenditure will be disallowed. Next, non-deduction of TDS 30%. So every individual, see, in the concept of TDS, TDS is a very big concept. In the TDS stands for tax deduction at source. So when any payment is being made, suppose if I have to make a payment, okay, I have to deduct certain percentage of tax on it before I make a payment. I'll just give you an example. Like if bank credits some interest to me, like bank is paying me interest of suppose 15,000, and before making the payment of 15,000, bank has to deduct certain percentage on TDS on that interest of 15,000. So 15,000, suppose we take the TDS percentage rate as 10%. So bank has to pay me 15,000, but it is going to deduct 1,500 as TDS, and it is just going to pay me 13,500. So suppose if any SSE who is liable to deduct TDS and he is not deducted TDS before making any payment, then 30% of such sum payable to a resident on which tax is deductible at source but not deducted, then such expenditure will be disallowed. Because in the case of bank, if you see, bank charges is an expense. Bank charges for an SSE is an expense, right? So if TDS is not deducted, the deduction of it will not be allowed while calculating income from your head, profits and gains from business or profession. Next, any sum payable on account of income tax. So suppose if you're paying income tax and you're showing it on your debit side of your P&L account, such expense will not be allowed. What is the reason? What is the reason for disallowance of income tax? Because income tax you're paying on the total income of the SSE. Not only the income on your business and profession, income tax is calculated on your income from head salaries, house properties, capital gains, income from other sources. So that is why, since this expense is not purely related to your business and profession, it is also related to your other incomes. Therefore, whatever expense the SSE is incurring in the form of income tax, it will be disallowed. You cannot take the benefit of this expense. Next, tax paid on perquisites on behalf of the employees is not deductible. So suppose if tax paid by the employer on non-monetary perquisites, which it is providing to its employees, okay, which is exempt under section, you know that it is exempt under the section 1010 in the hands of the employee. So in that case, that particular expense is not allowed to be deducted in case you're calculating profit from the head for the head business or profession. So these are the list of expenses which are totally disallowed if these criteria are met. Only if TDS is not deducted, then only that particular expense on which TDS is not deducted, okay, that has to be disallowed. Next, only when the interest, royalty, fees or fees for technical services is paid to a person outside India, to a resident, to a non-resident, to a non-corporate, to a foreign company on which TDS is not deducted, or the SSE has deducted the TDS but it has not paid to the government on or before the due date, then such expense is disallowed. Income tax act, income tax payment is disallowed. Then the tax paid by the employer on non-monetary perquisites provided to the employee is disallowed. So all these expenses are disallowed. Now moving ahead, Let us understand certain expenses which are allowed, but only in certain situations or certain circumstances. That means these expenses are allowed to be deducted, but only if it meets certain circumstances. Okay, if it doesn't meet that circumstances, then it is totally disallowed. So let us see first, payment made to a specified person in excess. Now, what do you mean by specified person? Specified person is nothing but a related person. Suppose, I'll just give you all an example. Suppose I am running a business, okay, where I appoint my cousin sister as an accountant. Okay. Now, the general market rate of the salary to an accountant may be suppose 15,000, but I am making her a payment of salary of suppose 45,000. So 15,000 minus 45,000, the extra amount what I am claiming is 30,000. Now, I will take the benefit of 45,000 in my P&L account. I will show in my P&L account that salary payment to whatever my cousin sister of 45,000. What government is saying that since the market rate is 15,000, you are making the payment in excess. Therefore, the excess amount is going to be disallowed and not to be allowed to be deducted from the income. Because like this, what will happen, many people will show unnecessary excess payments to their relatives, okay, as an expenditure, and they will put it in the debit side of the P&L account, and they will show less profit, and they will pay less tax. So in order to avoid that, what government is saying is, what does the provision says is, if any payment is made to a specified person. Now I will explain you what is a specified person in detail. That is to a related person. Now in case of individual, the related person will be the relative of the individual. In case of firm, it will be the partner of the firm to whom you can pay excess. In case of a company, it may be a director of the company or relative of the director to whom you are paying in excess. So this is the meaning of specified person. And suppose you know that whatever returns you're filing will be assessed by the assessing officer. So if any expenditure is incurred, okay, and the payment of which is made to a related person or entity, and the assessing officer feels that this is unnecessary, this is unreasonable, and this is over and above the market payment that is being made, then such excess will be disallowed. Okay. Next is cash payment in excess of 10,000 and 35,000 to a transport operator. Now, what happens is, government wants to eradicate or completely remove the cash transactions. Therefore, it has brought in this provision wherein it says that if any expenditure, okay, of which you're making some payment, okay, to a person in a single day, if you're making a payment, if any SSA is making a payment to a person in a single day, okay, otherwise than by any electronic means means it can include any in the form of check, or in the either in the form of bank overdraft or any electronic mode, otherwise than that means in the form of cash, which is exceeding 10,000, then such excess, the entire payment of such thing will be disallowed. Now, what do we mean by this is, no business person can make a cash payment to a single person in a single day. It is a day wise, okay, to a single person in a single day in excess of 10,000. And if he is making payment in excess of 10,000, this excess will be disallowed. Now, but in case of any person who is having the business, like if any payment is made to a transport operator for hiring or leasing goods or transportation of goods, the limit is 35,000. So in case of transport operator, when the payment is made to a transport operator, in that case up to 35,000 cash can be paid to the transport operator. In excess of 35,000, whatever cash is being paid, If it is paid in cash, it will be completely disallowed. Disallowed means it will not be allowed to be deducted from your income while calculating the profit and gains from business or profession. Next is disallowance of provision for gratuity. Now students, now when any provision for gratuity is made, see, you know that an employer is making payment to the employee, correct? Suppose if it is making payment to the employee in the form of gratuity. So you know what is provision? Provision is making like keeping amount for an expense that is certain to happen, correct? So now if the employer is not made the payment to the employee but just for gratuity, but is just making a provision for gratuity in the books, and provisions, you know, it comes on the debit side of P&L account. Now actual payment is not made for gratuity, but only provision for gratuity is made and kept in the books, which is debited to the P&L account. So therefore the provision says that such provision for gratuity, if it is being made, okay, it has to be disallowed and it will not be allowed as a deduction while calculating your profits and gains from business or profession. But this disallowance will not be attracted if the payment of gratuity is, suppose he is doing provision for gratuity and it is paying in the same year during the year, then this allowance will not be applicable. But just if he is just keeping a provision for gratuity for which he is not making the payment, then the provision for payment of gratuity to employees will be disallowed in the books of the employer. So these are the three situations where expenses are deductible only in certain circumstances. First case, payment in excess you're making to a specified person. Suppose to the specified person you're paying an amount which is normal amount and which according to the assessing officer is not unreasonable, then this payment is allowable expense. Next, if you're making a cash payment less of 10,000, then this is an allowable expense. Suppose you're making payment in excess of 10,000 but through an electronic mode, maybe through check, draft or NEFT, RTGS, it is still allowable expense. And if you're making the payment of gratuity during the same year in which you have made the provision, still it is an allowable expense. So all these depends on certain conditions, certain situations to be disallowed. Next, profits chargeable to tax, that is deemed income, which we have seen that in our format for calculating income from the heads, profits and gains from business and profession, we have added this deemed income in the last. Now what is this deemed income? One by one, let us see. First one is remission or cessation of trading liability. Now what do you mean by remission or cessation of trading liability? Suppose you have a liability, usually you show it on the balance sheet, you show it on the liability side. You have to pay some, you have a creditor to whom you have to pay some money. Over the period of years, suppose something happens to that creditor, or that creditor's address is not traceable, or that creditor is foregoing or waiving of your liability. But in your books, you had shown it as a liability. Now that liability, maybe due to any reason, is not to be paid by you. Maybe the creditor is no more, or maybe the creditor is not traceable, or maybe the creditor has waived off the liability. So in all the situation, what happens? The liability that you have to pay is no more a liability to you and becomes some benefit for you. So this some benefit will be treated as a deemed income as per Income Tax Act. So whenever there is some trading liability by the way of remission or cessation, the amount what you had to pay will be the value of benefit which you will consider it as a deemed income, and such income has to be added back to your profit while calculating profits and gains from business or profession. Next is recovery of bad debt subsequently. Now, suppose if any amount is recovered by the SSE against bad debts, which earlier you would have taken as a deduction, okay, you have to show it as a deemed income in the year where you have recovered the bad debts. For example, if for this particular year you know that a particular debtor, you know that a particular debtor is not going to pay you the amount, so if you're certain about it, you will record it as a bad debts, which you will show it on the debit side of P&L account. And yesterday we have seen that bad debts is an allowable expenditure, so for this particular year you will take the benefit of that expenditure. But over a period of time, suppose you recover that amount from the debtor, you recover the amount from the debtor, then what the provision is saying that earlier, since you had taken the benefit of it and now you have recovered the amount, therefore you have to consider such recovery as an income, because already in a particular year you had taken the benefit of it as an expense. So therefore, recovery of bad debts subsequently also will be treated as a deemed income, which you have to add while calculating profits and gains from business or profession. Next, brought forward losses of different business. Now, what does this mean? This means that if you are bringing forward any loss of any business that is defunct means which is already been closing down or which is no more in operation, if you're getting down the profits of that particular business, then you have to consider it as deemed profit or profit charge, and you have to charge that to tax. So that is nothing but which business is longer into existence or is no longer working or into functioning, then in that case you have to consider it as a deemed income and then add it to your profits. Next is deductions to be allowed only on actual payment basis. What do you mean by this? This means that expenditures will be allowed as deduction only when you are making the payment of it. If you're not making any payment of it and you're just showing that this particular expense, suppose bank interest, you have during a particular year bank interest and you're just showing that expense in your P&L account, actual payment you have not made of. So what government is saying, there are certain list of expenditures which you will be allowed as a deduction only if you have actually paid it, okay, on or before the due date of filing the return. Okay, so the first one is tax, duty, cess or fee under any law for time being in force. So suppose if you're paying any taxes, like suppose TDS tax, TCS tax, if you're making any payment of it, okay, or export duty, import duty, any duties you are paying or any additional cess you are paying, and obviously this is an expense in the eyes of the business and you will show it in the P&L account debit side, but you are allowed to take the benefit of this expense only if you have paid or made the payment in actual, then only you will be allowed as this deduction. If only you're showing for the purpose of the books but actual payment is not made in that particular year or before filing the return of that particular year, then such expense will be completely disallowed. Next, contribution to any provident fund or superannuation fund or gratuity fund or any other fund for the welfare of the employees. As we have already seen in the earlier slide that if the employer is just showing contribution to provident fund, superannuation fund or gratuity fund, but if there is no actual payment made, actually he is not making the payment but just he is showing a provision or just he is showing a contribution, then such expense will be completely disallowed. Next, bonus or commission for for services rendered by employees where such sum would not have been payable to him as profits or dividend if it had not been paid as bonus or commission. So obviously when the employees are working, usually many companies, they give the bonus or commission to the employees for whatever services they are rendering. Suppose they are showing it as payable, but it is actually not being paid, then such expense will be disallowed. Next, interest on loan or borrowing from any public financial institution, or it may be state financial institution, or it may be state investment corporation, then such interest on loan will be allowed as a deduction only if actually the payment is made. Just if you book the payment, if you just book that expense in your account, it is not, you cannot take the benefit of it. You can take the benefit of interest on loan only if actually it is being paid and the payment is actually being done. Next, interest on loan or advances to any scheduled bank. So again, if any interest on loan or advances is made to a scheduled bank, such expenditure will be allowable expenditure only when the payment is made on actual basis. Next, payment in lieu of any leave at the credit of his employees. So payment in lieu of any leave at the credit of his employees, that is leave encashment, only if it is made, if the payment is actually being made by the employer, then only the employer can take the benefit of it. If not, it cannot take the benefit of it. Next, any sum payable to Indian Railways for use of railway assets. So in this case, if actually the payment is made, then only you will get the benefit of it. Otherwise, it will not be allowed as a deduction from profits and gains from business or profession. So all these are deductions to be allowed on only actual payment basis. So by this, we understand that there are certain admissible deductions from section 30 to 37, inadmissible deductions which you will not get the deduction of it, like in case of non-deduction of TDS, income tax. Then we seen expenses or payments not deductible in certain circumstances, like cash payment in excess of 10,000, and in case of transport operator we saw it was 35,000. Profits chargeable to tax, we saw cessation and remission of trading liability, recovery, subsequent recovery of the bad debts. And in other provisions, we did see that certain expenditures are allowed only when the actual payment of it is being made. So these are the several different sections where you know what particular type of expenditure is allowable, what particular type of expenditure is disallowable. So based on that, you all have to solve the sums. Students, do you all have any doubt in this? Students, do you all have any doubts in this particular sections, whatever I've explained?
No, ma'am.
Okay, so we have seen different provisions of the scheme under deduction. So we have completed the scheme of deductions and allowances from the head, profits and gains from business and profession.